In this session, I'm going to look out for how the sovereign credit worthiness and financial stability got impacted because of the recent financial crisis. And just to understand, probably the financial crisis or the global economic crisis, which is typically called as, it though it has originated in the financial sector, what we see is finally it has landed up with the sovereign risk, a lot of countries defaulting. So there is a sovereign risk that has come out when the country itself has gone majorly into insolvency kind of issues. That is what has led to the major global economic crisis. Because to start with, right, if I have to understand the key conditions that have contributed to this turmoil, I should look out for insufficiency in the capital, insufficiency in the capital in the banking sector. So they have given loans without proper backups. It's a huge and every bank was very highly levered, right? The loans versus the equity ratio, what they were maintaining was the loans were quite higher compared to equity, even to the closer extents of 50 times. So the banks were very highly levered and maturity mismatches were very high. So short term funds, long term loans. So there was a very heavy maturity mismatches. They were giving real estate loans for a longer term periods, whereas they were backed heavily by short term deposits. And even the currency mismatches have happened to a very large extent. Now, they they uh, they were typically taking large risks because of the high levered nature, and the limits that were imposed were very minimal. And now, because of this, there is a huge capital gap, and in some cases the sovereign has to come forward to bridge this gap. That is one reason even the sovereign credit worthiness got impacted because of the financial stability. And the other thing which people generally talk about is coming from the sovereign or the government perspective. When there was a boom during 2002 to 2007 period, the revenue, when there was a boom, whatever was the growth in the revenues, there was no proper cushion against it. The revenues were growing, the economy is improving, and because of that it has created a false confidence, and because of the abnormal lendings that have happened, the reserves that were accumulated during the boom period were not sufficient during the crisis period. Though there was a boom during this entire period, the sovereign did not take care of sufficiently backing it up for the period where the economic gloom could come out. So the reserves that were accumulated during the boom period to fund the obligations that are going to come up in the later years were completely insufficient, which means the crisis has even more mounted up. And the third major thing which we typically look at is the kind of integration that is present between the financial services sector and the sovereign sector. There is a lot of close integration that is present between the global financial systems and the sovereign itself. Because, though it is good, I mean, to some extent, when the market is positive, this kind of interaction will really create an effective system across the world. But in times of crisis, probably it will have a compounding impact on capital, liquidity, all these things, and that is what has happened during the recent economic crisis. Now, one thing which people try to understand is uh, whether the risks have transmitted from financial sector to the sovereign sector during this crisis. Is it this financial sector to sovereign sector, which is the country, or were they transferred from sovereign to the financial sector? Probably the answer lies in both. How did the risk typically get transferred? Now, when I look at the financial sector to sovereign sector, one, the policies, they are under the hands of the sovereign itself. The improper policies of the government, which has led to the fiscal balances growing up drastically from the financial institutions. There was a heavy boost in the growth in the fiscal balances because during the credit boom, the obviously the fiscal balances have gone up quite drastically, and because of that, it created a false impression, or probably it has hidden the weaknesses in the underlying financial system. Even the governments, the fiscal position, because of the typical economic boom, revenue started coming up. So it has created an impression that even the government fiscal position is very strong, very highly credit worthy. So the government, instead of maintaining a proper backup and a reserve, it continued spending, and that had created and that everyone knows it is going to be unsustainable in the long run. So government could not take care of how to address the boom situation to a large extent, and the lending constraints on the financial institutions. Coming to the lending constraints on the financial institutions, which has created a huge public sector deficit. And this again will create the credit rating of the sovereign going down. The sovereign credit worthiness is getting challenged because of this. Because see, the whatever are the lending constraints that are there, it has resulted in the macroeconomic costs, and the fiscal accounts were getting even more weakened. And if there were no proper buffers, and so borrower quality is getting a decline, economic activity is getting hampered, tax revenues are getting hampered, government expenditure is getting raised. So overall the credit worthiness of the sovereign is getting very heavily challenged. And the third is a very important aspect where the risk from financial sector have passed through the sovereign sector itself. It is primarily the support which generally the government gives to uplift the financial sector, like bailouts. When a company has gone almost bankrupt, the government will come forward to bail out, will offer some kind of funds to bail out those kind of firms. So many firms in the financial sector undergoing through a turmoil. The sovereign has to come forward and it has to support the falling financial institutions so that overall financial stability in the country can very well be maintained. So whichever are the banks which were on the verge of bankruptcy, the sovereign had to get in to provide financial support to them, injecting liquidity or increasing the liquidity position by either directly injecting capital into it, doing some asset purchases, or providing some kind of debt guarantees and all. So overall, to improve the financial stability, even their positions and their credit worthiness got very badly impacted, which means from the financial sector, the risk got transferred to the sovereign sector. Similarly, how do I look at whether the risk got transferred from a sovereign to a financial sector? Especially, I talk about a few dimensions here. The portfolio exposures. Generally, we see a very large portfolios of the banks or something. They have a very heavy exposure to domestic or foreign sovereign risk. Because you see any financial institution, very good products of the financial institution, they are exposed more to sovereign risk because the majority of their portfolio contains sovereign bond. To a large extent, the domestic sovereign bonds, but at the same time they can be exposed even to foreign sovereign risk because they do invest in foreign government bond portfolios also. So that is one major reason the financial services sector also got affected from the sovereign loss. Then generally with respect to the funding, what we see is the government bonds and the government securities are taken as a collateral, right? Because they are assumed to be risk free. So to a large extent for any kind of funding activities, you see that the government securities are typically taken as a collateral. Now, because the sovereign failing in large number of areas, the value of the collaterals have gone down drastically. So whatever was so even which means the bank's funding capacities also have gone down drastically because the collateral which they have taken, the value of that collateral has gone down drastically. So the funding capacity of the banks also had gone down considerably. So that is one more way where the sovereign risk got transferred into the financial risk, and the capacity, the sovereign capacity to assist. See, they are not able to assisting the banks under pressure. Generally, as I said earlier, they provide support to the banking sector. Now, sovereign has expressed its incapability to assist the banks in case of crisis. So, if they have weakened, means they are not able to assist the banking sector. So, the banks had to take more and more conservative approach because the capacity to provide the assistance to the banks under pressure, so they don't have a proper backup. Now today the banks cannot have a proper backup from the government that they will bail them out in case they are going under pressure, which means from a bank standpoint they have increased the credit risk. And the other important aspect which I look at in this dimension is the crowding out effect. What is this crowding out effect? See, the government debt, whatever so many government bonds are there, they have lost their values. Their values have gone down because of the risk increased with the government bond. So, more and more increase in the yields of the government bond will force the private sector bonds to yield even more, because the private is considered to be more riskier compared to the government instrument. So it is expected that the yields on the private bond should be much more than that of the government. So the government yields going up will automatically result in the private yields going up, and at that high yield the private may think of not borrowing, not raising capital at such a high yield, so they may even back out from the debt raising procedure itself. So the private senior debt itself, which was having a better rating earlier, because it has to be more than the government, because the government bonds are perceived to be risk free, the debt raising activity itself will go down. So the availability of the bank funding will typically go down, and it results in a crowding out effect. So an increase in the yields of the government securities will create a crowding out effect on the private sector, even if it is a senior kind of a bond. So that is going to happen, which is again a transfer of risk from sovereign to the financial sector, and much more, or above all, what could also result in is a loss of market confidence. Another major area that can come out in this aspect is a loss of market confidence if the sovereign debt is leading more and more into fiscal consolidation. A lot of market confidence is getting impacted, and that would create ripples in the financial sector from the sovereign sector. So there are mechanisms where the risk got transferred from financial sector to a sovereign sector, and even from a sovereign sector to a financial sector as well. Now, one more dimension I would like to look at, probably what had happened from 2002 to 2007, when there was a typical credit boom in the world. Across the world, when there was a credit boom, during that period, what we have seen is, even from a company's standpoint, sovereign debt to their GDP ratios, which is a measure of the financial stability of the country, they were well within the acceptable limits. They were not getting visible as warning signals. And during that time, across various countries, even the bond yields, the government bond yields, or even private corporate bond yield, they were much lower. The sovereigns, the credit rating which was associated with the sovereigns for various countries, it was much quite comfortable. And this entire thing has created a kind of false impression. And even when we talk about the banking sector, the banking sector was remaining highly profitable over the years. So what has actually occurred is, from the bank's dimension also, because they were lending heavily, they were trying to go for short-term funds, right, in the form of deposits or whatever, the short-term funds, and they are using it to fund the long-term loans. A huge maturity mismatch in the process. So they were very heavily resorting to the short-term funding, and because of this, obviously any short-term fund cannot build up the reserves for the longer-term obligations. So when the market started falling because of the insufficient reserves that are there here, they are not able to meet their long-term obligations. Because what is typically observed even in this context, why what had majorly created a problem is, see, though there was a warning signal at some point in time that the private credit to GDP ratio has actually gone up, and the real estate prices also have gone up much more than their normal predicted growth levels. Rather than these actually can be taken as warning signals. Private credit growing drastically, real estate prices going drastically can very well be viewed as a warning signal of the liquidity getting more or less compressed, and the growth getting hampered within no time. But somehow it could not get realized by the entire market that there is something that is going to come up in the near future. But otherwise, these kind of ratios, if they are increasing, it could very well be sensed as some kind of credit event going to occur in the coming future. But it has not got sensed, and the business cycle also. Probably, if I have to look at the other dimension, the business cycle continued to show expansionary kind of a phase. So the public sector balances are always showing positive, and because of that, no reserves were being built. See, generally also when you say that I keep getting my money, you don't feel like saving it. Okay, I'm getting my money. So even if you look at it from an individual standpoint, yeah, I'm getting my salaries, heavy salaries I'm getting. So why should I save? I will anyhow earn in the future also. That's a typical mentality that exists at an individual level. The same thing percolates to the government level. Okay, we are getting our revenues because individuals are getting their revenues. Everything is positive, balances are positive. Why should we think of saving for the future? And that kind of an attitude had created the whole ripples in the market. And even because of the increasing asset and real estate prices, the inflation and the purchase inflation has gone up, the purchasing capacities have gone down, and even from a government standpoint, it had to continue spending freely on these things, which has resulted in liquidity crisis as the years progress further. So that is one more important reason that is visualized. Though in 2002 to 7 there was a credit boom, it was typically not captured properly, reserves not built up properly, which has created enormous fall at a later date. And especially during the financial crisis, the sovereign creditworthiness was a major issue. And what had typically resulted there was a negative correlation where CDS spreads, sovereign CDS spreads were increasing and bank CDS spreads were decreasing. Means sovereign creditworthiness has gone up drastically, which is clearly indicated by a sovereign CDS spread increasing, whereas the bank CDS spread was actually decreasing. It's a clear indication that this kind of a negative correlation had questioned the sovereign creditworthiness very deeply during that period. And during this financial crisis, even the banks, the foreign claim, the banks' foreign claims on sovereigns. So whatever they have invested in foreign government bonds, their foreign claims have decreased. Even the public sector debt has gone down. So I mean, because the foreign claim on the sovereigns had declined, so the public sector debt also has gone down drastically, which has resulted. See, whatever was the sovereign debt that was there, that was matured on the bank's balance sheet, it was not able to be renewed, and whatever the value of that market debt had already been down valued, written off in some cases by the major banks, and the foreign government debt, to a large extent, it was sold off to the external commercial borrowings or to some domestic banks. So overall it caused a kind of a ripple effect. But what we see is by 2012, the global financial system has become strongly integrated. So wherever when we are this kind of integration, so here when a decision has been taken within one jurisdiction, can significantly impact the economic and financial developments in the other. This is one major area. Any decision in one single state could have a ripple effect or multiplying effect across the other states. So here it is being perceived that rebuilding the public confidence is one of the most important aspects the as a part of reworking exercise. So to spread the future crisis, to stop the spread in the future crisis and all, we see lots and lots of recommendations coming up, especially from the Basel standpoint. You have seen that there is a kind of a floor that is set on the leverage ratio. They say that the leverage ratio should be 3%, which means the maximum, even if I see the leverage at any point, it cannot be more than 33 times the equity, right? There is a kind of a floor that has been set on the leverage ratio. It should be at least 3%, means you cannot lend more than 33 times to your equity, which was much an improvement over what has happened during the crisis period. And from a bank standpoint, they have to clearly segregate the sovereign risk and better not apply a risk-free value to the sovereign risk. Let it not be a zero assignment to the sovereign debt. Probably there should be an appropriate risk weight that needs to be applied for the sovereign debt, because it is not purely risk-free. And from the government standpoint also, they have to come out with various actions to reduce their high levels of debt. Even some kind of fiscal consolidations have to happen. They have to come out with reforms in a timely fashion, and the main role of the government is to rebuild the investor confidence. All these things should happen in the short term, and in the long term, counter cyclical approach, right? They have to understand that a boom period will definitely be followed by a kind of a recessionary period. So developing proper reserves and a counter cyclical approach needs to be maintained, and that needs to be more and more credit worthy itself. So that is one major lesson that comes out as a part of the recent financial crisis and the global economic meltdown. There are so many lessons for the sovereign as well as the financial sector from this perspective. So, a good understanding of the sovereign versus the financial sector on the after the financial crisis has actually occurred is very much important for us. So, if you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.